Welcome to the start of the 23-24 financial year, in which we note that there's been a number of changes pertaining to contributions, thresholds and minimum pension payment obligations, together with a timely reminder of procedural changes to the contributions work test. On 1 July, the superannuation guarantee rate increased from 10.5% to 11%. Advisors and members will need to calculate the increased SG rate when considering whether any availability under the concessional contributions cap, which of course did not index and remains at $27,500, giving rise to a possible personal deductible contribution strategy and/or salary sacrifice arrangement. Furthermore, the increased SG rate will need to be considered if the client's total superannuation balance was less than $500,000 as at 30 June 2023, and the unused concessional contribution rules are being utilised. The government also announced the removal of the 50% reduction applicable to the minimum pension payment obligations for account-based pensions, including TRISs, and market-linked income streams, amongst others, for this current financial year onwards. The removal of the 50% reduction was not unexpected, but advisors and members may need to readjust their cash flow calculations if the reduced minimums have been affected over the past few financial years. As was announced late in the financial year, the indexation of the general transfer balance cap and total superannuation balance threshold both indexed to $1.9 million. The indexation gives rise to a number of issues of which advisors need to be aware in managing retirement phase account-based pensions in respect of the general transfer balance cap and non-concessional contributions in respect of the member's total superannuation balance. Let's take the easy one first. The total superannuation balance threshold of $1.9 million and the member's proximity to this amount may provide a constraint as to the level of non-concessional contribution entitlement. The concept of non-concessional contributions also generally includes contributions not allowed as a tax deduction, spouse contributions, excess concessional contributions not released from super, but does not include government co-contributions, downsizer contributions, eligible COVID-19 re-contributions, eligible small business CGT contributions within the cap, or eligible personal injury contributions. In many cases, we consider the capacity for a member to utilise the bring forward arrangement for non-concessional contributions. If the member's total superannuation balance is now less than $1.68 million, as at 30 June 2023, and the member had not previously entered into a bring forward arrangement which is still in operation, the member may contribute up to $330,000 over 3 years, assuming, of course, that the member is under age 75 at any time in the financial year in which the bring forward arrangement is triggered. Any further proximity to the $1.9 million threshold may provide a further constraint as to how much may be contributed under a bring forward arrangement and needs to be carefully checked. Having said that, though, it's important to also note that the current SIS Act and regulations do not specifically prohibit non-concessional contributions being made in excess of the available cap space. If excess non-concessional contributions are made, the issue becomes one of remediation, either by way of retaining the excess contribution in the super fund and paying 47% tax on the excess, or by releasing the excess and 85% of the associated earnings as calculated by the ATO. The increase of the general transfer balance cap through indexation to $1.9 million has given rise to a number of complex calculations that may need to take place in the event that advisors and members are restructuring existing retirement phase pensions, contemplating the commencement of new retirement phase pensions, or who are in receipt of a TRIS and turning age 65. When considering any amount of the transfer balance account that may be still accessible to a member, a series of calculations must be made in order to establish the unused cap percentage and therefore the dollar amount available under the indexed transfer balance cap applicable to that member. When the original legislation was introduced in 2017, it was not immediately apparent as to the impact of indexation on a member's entitlements if they were already in receipt of certain pensions as at 30 June 2017, or commenced new retirement phase account-based pensions on or after that date. However, with 2 phases of indexation being applied to the general transfer balance cap, we are now acutely aware of the need to be very precise in determining what entitlement, if any, is available to a member to commence a new retirement phase account-based pension, or the implications of a restructure of any existing pensions. It would not be surprising to find that each of your clients has a different entitlement subject to their previous usage of the general transfer balance cap. We also need to take into consideration that a TRIS will automatically convert to a retirement phase pension upon the member attaining the age of 65, and care must be taken to ensure that the member does not create an excess balance requiring a commutation authority to bring the retirement phase TRIS back into order. If you require any assistance with respect to the calculations, please don't hesitate to reach out. A timely reminder too that arrangements to satisfy the contribution deductibility requirements by meeting the work test are now to be found in the Income Tax Assessment Act 1997 rather than in the SIS legislation and regulations. In changes that took effect from 1 July 2022, the work test is important in determining whether a member can claim a tax deduction for personal contributions made on or after their 67th birthday, and up to and including the day that is 28 days after the end of the month in which they turn 75. Importantly, the work test can be met at any time in the income year in which the contribution is made, and the member is not required to meet the work test prior to making the personal superannuation contribution for which they wish to claim a deduction. It is now the ATO which determines whether the member is eligible to claim a deduction on the basis of making the work test, not the superannuation fund. No doubt, there will be many other changes impacting the superannuation environment during the course of the year, and we look forward to keeping you updated as to when and if they occur.